Hi everyone, welcome to a short course on advanced valuation technicals. I'm Raymond Boltron, and we're going to learn how to value a company using the McKinsey way. It's based on their book called Valuation. All right, let's take a look at our first objective. Uh, Learning objective number one, capital, how much? We're going to take a look at how we calculate perpetuity and annuity, and we're going to introduce or find the way how to calculate the risk-free rate, cost of debt, and the cost of equity using the capital asset pricing model. And based on all of those sources of uh, capital, we're going to calculate the weighted average cost of capital, or WACC. So, and then on our learning objective number two, we're going to learn how to transform the accounting statements that we see on the annual reports, like the income statement and the balance sheet, to a more of a operating uh, metric, so we can calculate the free cash flow and the return on invested capital. And we're also going to talk about the below enterprise value adjustments. And objective number three, we're gonna look at different examples on how to calculate the intrinsic value, and we're going to look at how to calculate ROIC using real statements from the 10K itself. And we're going to do another example, supposed to be an exercise for you guys to pause the video and solve yourselves, and then we'll go through it together again. So let's start. Capital, how much? If I give you $1,000 per year starting next year and forever, how much would you pay me today? So think about it. How much would you pay me today? Forever. I'm going to be rich. Well, let's ask the first question. Am I serious? Assume yes, 'cause sometimes I might be just joking and I might not be serious. So let's just assume yes. It's supposed to be a joke. And well, what are my risks of not paying? Well, let's assume that I have some risk. Maybe I would decide to not pay you $1,000 next year, or maybe I die. Well, what are my opportunity costs? Well, let's just assume 10%. So we'll represent that risk by your opportunity cost of 10%. So how much would that be? How much would you pay me today? Well, you just divide it by the amount of risk that you're trying to get. Well, 10%, you divide 1,000 by 10%, that would be 10,000. So you would have to pay me $10,000. Very easy formula. You just take the payment divided by the required rate of return. Well, now let's suppose to say my required return is only 5%, because suddenly maybe I have a new job, I can pay 1,000 per year, no problem. Um, $1,000 wouldn't be as much of a money, so my risk went down to 5%, almost half, or basically half, from 10% to 5%. So how much now? So you just divide it two, and you get $20,000. You would have to pay me $20,000. So see the difference. By having half of the risk, you would actually have to be willing to pay twice as much. All right. What if I'm just gonna give it for the next 3 years, not forever? Because you never know what's gonna happen forever. How about just next 3 years? I promise to pay you $1,000 per year starting next year. How much would you pay me today? Well, let's just assume 10% opportunity cost. How much would it be now? Well, um, I guess intrinsic value of that security or promise, let's say, um, is the discounted cash flow that you're gonna receive. So 1,000 next year, 1,000 the next 2 years, and then 1,000 the third year, and you discount it today, and that's what the value becomes. So it's about 2,487. Well, how about 5% now? Just like um, the other example, you got rich. So you just change it to 5%, 1 plus 5%, and you discount it today, and it's 2,723. And you can see the difference is 236 more. Not that twice as much, right? Well, because it's only for 3 years, and for those next 3 years, your opportunity marginal cost would be $236. So the lower the required rate of return, the higher the amount that you would pay. So you see an inverse relationship. All right. Let's start with risk-free rate. So which risk-free rate do we mean? Well, it depends on your time horizon, right? Because when you invest on something, how long do you plan to invest on a stock? And it also depends on the currency that is in for. For example, what if you invested something in a sketchy country, like um, let's just say Iran, and there's a lot of risk because of political instability, and so the risk-free rate might be higher versus a U.S. dollar, and etc. What I normally use and what people normally use is the U.S. 10-year T-bill rate for U.S. companies, of course, or which I usually use is the 30-year T-bond. Why? Because I assume to hold the company forever. When I value a company, I want to assume that I'm buying it for forever. And next is cost of debt, the RD. What I usually use is the current bonds YTM, or yield to maturity. Sometimes that bond might not be liquid in the market, and so I usually take the average of asking bid, or basically most of the time it's the last price that it was sold for, because it's more representative of the value of the bond. If uh, if that bond exchanged hands a lot more than not, because if the last price was based on a few years ago and uh, economic interest rates changes, then the last price might not be representative of the current value of that bonds, or the current cost of debt of that bond. So be just mindful of that. All right. So next slide. Well, cost of equity. We usually calculate the cost of equity using the capital asset pricing model. It's basically a linear regression with the beta as the slope, and so you start with risk-free rate plus your beta. Beta means your market risk. How much market risk are you taking? For example, if you have a beta of 1, then your stock moves about the same way as the market, or if your beta is greater than 1, then if the market goes up 1%, then your stock usually goes twice as that. And reverse of that, if the beta is let's say negative, uh, let's just say zero point 0.5, then it only moves half as much as the market. Well, what if the beta is 0? Then it's uncorrelated, right? Because beta um, supposed to represent the market risk. So if you have zero market risk, then it might be uncorrelated with the market. Um, and so the other part is, oh wait, beta, I usually use the 2-year weekly or the 5-year weekly or arbitrary. Usually you can easily get the beta number. You don't have to do a linear regression. So you can just get it from Bloomberg, or even Yahoo Finance have the 5-year monthly or weekly. Um, but usually you use your Bloomberg, you just enter the function beta, and then you can adjust it to whether you want it to be 2-year weekly or 5-year monthly or whatever. Um, and then the next one is market enterprise risk. I'm sorry, ERP, or the equity risk premium. Um, oops, sorry. Let's go back. Um, so I have a tiny uh, a tiny mistake on the. This should say equity risk premium. P. All right, let's just fix that real quick. All right, so well, what equity risk premium would you use? Usually, it would be a historical long term, or the Modern has an implied market risk or equity risk premium on his website. So that'd be a good way to find it. I usually use the Modern's too, because um, it's more current and representative of the market. And then you put in the formula, and then you get the cost of equity. Now we have the cost of equity, the risk-free rate, or the cost of debt. Um, then we can calculate our WACC, or the weighted average cost of capital. Um, Sometimes you have preferred shares. You can see it. I notated it with a P, but most of the time the companies don't really have the preferred share. So you can disregard it for now, and then we'll take a look with the other ones. So let's start with equity because it's more straightforward. You get the weight. So how much portion of your total capital is equity, and then you multiply it by the cost of equity. The same with the debt. Um, how much of your capital is debt? You multiply it by the cost, but that because the interest expense is uh, uh, can be a tax shield because it lowers your earnings before taxes, and therefore you're paying less taxes. So you want to take off the tax shield, and because it has some benefits versus using just pure equity. So you take off the tax shield, and then you calculate the weighted average cost of capital. And usually it looks like this. I think I got this from the internet, and you just take the weighted uh, cost of capital. Why do you weight it? Because you're not using the same amount of capital on each, so you have to weight, uh, uh, proportion wise of those costs to get the more appropriate cost of capital. All right, and this is one of the examples that I use to calculate. You could see the cost of equity using the three inputs. You can see it right there. Um, what I use for the risk-free rate is the 10-year yield. Sometimes I use the 30-year bond, U.S. bond, and then you can see uh, the after-tax costs of that right there. Oops. And then I use the marginal tax rate to take off uh, the tax shield benefit that we get. Not remove, but add basically tax shield. Um, and you can see I use the market value of equity and the market value of debt. The book value actually is closer to the market value, so I just use the book value for this on their most current um, 10K, and you can see they have more equity than debt, and so um, it's because you can see that it's a lot cheaper than equity, um, and so it it doesn't. If you have the same weight, then it would be closer to like 5%, but it's not weighted because, or it has to be weighted because most of your capital is in equity, and so it's closer to this 8.7%. All right. Just to recollect, we talked about how to calculate perpetuity by just taking um, the payment amount divided by uh, the cost, the required rate of return, and then we talked about annuity, which we basically um, discounted each cash flow to today. And then we talked about risk-free rate, the cost of debt, and how we calculate the cost of equity, and to calculate the WACC. All right, and the next video we're going to talk about learning objective 2. All right, see you.